Right, hello everybody, and thank you for joining us and your patience while we wait for everyone to join in. So I think we're there, maybe a couple will join as we go on, but we will crack on with today's webinar, which is everything you need to know about your finances in Spain, whether you're planning on moving or already living in Spain. An absolute mouthful, so I will call it finances in Spain from now on. So we will start the webinar, and here is the agenda, and just to let you all know, we've changed the agenda slightly from how it was advertised. The reason for that is we're running a series of webinars at the moment, and we've already done one that's covering Spain as a whole, and we will repeat that. And today we're just focusing on the finances. If you are interested to learn more about visas, residency in Spain, then please visit our YouTube channel. Those webinars will be up in the next couple of days. And everyone here today, I encourage you to visit our YouTube channel, subscribe, because there will be a lot of information that we will add there, which should be helpful. Like and share with people who may enjoy it. So today's webinar, we will make a quick introduction, who we are, if we haven't spoke to you before. Then we will cover UK inheritance tax and Spanish succession tax. Those two go hand in hand. Then we move on to income tax and the possibility of transferring your UK pensions. We will then cover capital gains tax and wealth tax, and we've got an interesting update regarding that. We will end with some frequently asked questions and open up the floor for any questions you have. There is a feature on Zoom where you can submit your questions that we will answer. We'll get to those at the end of the webinar, but feel free to submit those as we go, so they'll be ready for us at the end. So quickly, Fiduciary Wealth Management, who we are. So my name is Matt Penfold, advisor and director here at Fiduciary Wealth. Worked in financial services for 20 years and spent the last 4 years working here in Gibraltar, but I actually live across the border over in Spain, advising and looking after our clients. With me is our managing director and founding partner of Fiduciary Wealth, Correa. Paul has years of experience in financial services. I won't say how much because I'll reveal his age, but there's plenty, trust me. Paul, initially working for the Inland Revenue, moved into private banking before founding Fiduciary Wealth in 2007, partnering with Islas 1892, who happened to be the oldest law firm in Gibraltar. Aside from our legal roots, Fiduciary Wealth is a member of MGI Worldwide. You may have heard of them. They have a top 20 global network of accountancy and tax advisory firms. So we're quite unique to most advisory firms in the sense that we've got those legal and accountancy connections, which make us a little bit quirky and add to the value that we can give to people. Our goal is very simple. We want to positively shape the wealth of the expat community by offering unbiased, expert advice that delivers the solutions and outcomes exactly as you seek. So that's us. We move on to the first part of the webinar, and here we will cover inheritance tax in the UK and succession tax in Spain. So Paul, can I hand over to you and you can explain this a little bit for us?
Yeah, thank you, Matt. As you rightly, as per your introduction, Spanish succession tax is based on tax residency, like all Napoleonic law countries, whether it's Spain, Portugal, France, Greece. You pay inheritance tax where you are tax resident. Unfortunately, the UK is quite quirky in the sense that UK inheritance tax is based on the concept of domicile. So even though there's a double taxation treaty between the UK and Spain, which covers different income streams, inheritance tax is not captured by the double taxation treaty. So theoretically, you could be liable both in Spain and in the UK, and even though in practice you should get credit tax relief, it is messy and cumbersome. So Spanish succession tax varies by autonomous region. So for example, in Andalusia, if you pass on assets to your heirs, if they're direct family, then on the first 1 million euro of assets, there is no inheritance tax to pay. And then anything in excess of 1 million euros, you pay a minuscule rate of tax, which is 1%. So I think they have simplified and reduced inheritance tax in Spain quite considerably.
Absolutely. Yeah.
The bad news is that for a Brit that moves to Spain, even if the value of your estate is very low or certainly not considerable, you're still exposed to UK inheritance tax by virtue of your domicile of origin. Now, your domicile of origin is something you acquire at birth, and normally it's taken from your father. Where you are born, where your father is born, you don't know who your father is. It can happen from time to time. We've had cases. Then it'll be your mother. And whilst you can claim and acquire a domicile of choice by settling in a country with the intention to stay there permanently. So in other words, you leave the UK, you move to Spain, and your intention is to stay in Spain. In theory, you become non-UK tax resident for inheritance tax after 5 years of non-residency. The reality is somewhat different. It is fraught with difficulty, as there are many rules that apply, and the burden of proof always falls on you to prove that you've actually acquired a new domicile of choice. So we would always recommend that an individual doesn't rely on a domicile of choice to protect themselves from a potential liability to UK IHT. In our experience, it's not uncommon for Brits to return to the UK, even if it's temporarily due to ill health, or perhaps one of the spouses has passed away and you return permanently, in which case it triggers UK domicile. So yeah, extremely complicated, because even the most tenuous of ties can mean that you remain UK domiciled. HMRC will always adopt a very tough line when it comes to domicile. So things like business interest, social connections, property ownership, or even intentions can result in an individual being considered UK domiciled for IHT. Yes, I mean, over time we've seen insignificant ties being challenged by HMRC, and as I said, even the most tenuous of grounds is enough to dismiss claims that an individual has opted for a domicile of choice. So yeah, we can even go to a high-profile case, Andrew, which is the Welsh actor now deceased, Richard Burton. He lived for many years in the US. He moved to Switzerland in 1957. He passed away in 1984. He was given PACA advice by a leading accountancy tax practice in the UK, and he thought there would be no liability. Of course, he doesn't know whether he paid because he passed away. Such is how this works. But the UK tax authorities made a successful claim on his estate for inheritance tax on the grounds that he never actually relinquished his UK domicile, even though he had severed his links with the UK 30 years prior. And the claim was successful on the grounds that he purchased a burial plot in Wales. So he retained his emotional ties. This is where I go back to the intentions. What were his intentions? Yeah. So he had the emotional ties with the mother country, and he always intended to return to the UK according to HMRC. Apparently, he requested to be buried in the colours of the Red Dragon of Wales, and he was buried with a copy of Dylan Thomas' poems. That was enough to deem him to be UK domiciled for IHT, and his estate of 5 million in 1984, which is a considerable amount of money in today's terms, was subject to a bill of 2.4 million sterling. So, yeah, the good thing is that once you become non-UK tax resident, it really opens up a lot of tax planning opportunities to restructure your financial and tax affairs to either mitigate or potentially eradicate completely your exposure and your liability to UK inheritance tax. So the important thing here is to plan early and to do it properly. So yes, you're exposed to UK IHT, no Spanish succession tax, depending on the value of your estate, is minuscule nowadays, is almost a non-issue. But like everything else, you know, you have to plan.
Okay, wonderful. And Paul mentions there about opportunities as an expat to plan against your UK IHT, and we will cover one such opportunity a little bit later. It's almost like we planned this, Paul, that we know what's going to happen.
Exactly.
But, so we move on to the next part, and just before we get to that, I kind of reiterate what Paul said. We talked about Spanish succession tax, and we use the example for Andalusia because Spain is very unique in the sense that the taxes can be a combination of the state taxes and the regional taxes, and in some areas the regional governments or representatives can control it. Part is controlled by the state, which so we slightly mislead you when we say everything you know about your finances in Spain, because we can't list through every single region in this webinar. And also, this webinar is for information purposes. If you are serious about planning properly, then it has to be a kind of one-to-one conversation. We pride ourselves in giving tailored advice, not a one-fits-all answer to everyone. So please feel free to reach out when the time is right. So we talk about income tax, and we've used Andalusia as the example there. Income tax is a little bit odd in the sense that when they devise a tax rate, half of that is the tax rate set by the state and half of it is set by the region. So although income tax rates will be similar, no matter where you are in Spain, they will differ slightly. So we've used Andalusia as the example there. These are figures for 2022, but there have been some recent announcements here where they're changing various tax rates and laws. So we've provided that as a guide to give you an idea of what you may face if you're looking to move here. In Spain, there is a personal allowance similar to what we have in the UK, but it's much less. It's around €5,500, does increase a little bit when you reach age 65 and again as you get older, but it's much lower than we're used to in the UK. So there's the income tax rates and your worldwide income, if you are a Spanish tax resident, would apply to that. We talk about being a Spanish tax resident, that's based on where you live usually or where your main home is. Again, we go into more detail on that on another webinar. So if you're unsure about that, look that up and we can help you with that. So then we talk about transferring your UK pensions, because this is an option that we discuss very often with clients of ours and something that can really help with. So I will touch on a little bit about the options that are available in a minute, Paul, but the last year or two post-Brexit and beyond, there's been some kind of changes with UK pensions and transfers, and it is becoming a bit more of a difficult process.
It is. I think, there's new UK pension transfer regulations, which were introduced in November 2021, is the UK Pensions and Pension Schemes Act 2021, which enables UK pension saving schemes trustees to refuse a UK pension transfer if they consider that there's a risk of pension scamming. So in the past 9-10 months, the length of time it takes to process a pension transfer has increased exponentially. Processing times are getting longer. They're asking for more due diligence to satisfy themselves that there's no pension scamming. But in reality, I think they're using this act as a pretext to make it as difficult as and awkward as possible for British nationals to transfer their UK pension benefits into a structure which is probably more suited for an individual who's living overseas because of the tax efficiencies that they can drive. And this is, the UK pension industry lobbying the UK government to try and stem the flow of pension assets that is coming out of the UK into other countries. Our concern, as you know, Matt, is that there's a risk that post-Brexit, the UK, which is no longer bound by the four freedoms, the EU four freedoms, one of which is, of course, the free movement of capital, that they might decide to extend the overseas transfer charge of 25% to EEA countries, which is EU countries plus Norway, Switzerland,
Liechtenstein, yeah, I think.
And someone else, yeah.
Yes.
I think, in fact, Gibraltar maybe.
And Gibraltar sneaks in there.
Into the EEA. So you've got, on the one hand, new pension legislation slowing down the actual process of transferring your pensions out. You've got the risk that the UK government, on a post-Brexit basis, decides to extend the overseas transfer charge to the European Union countries, EEA countries, which would stop in its tracks any future pension transfers. I think just generally it's becoming, and of course, the Financial Conduct Authority in the UK has made it more difficult to transfer defined benefit schemes. So the process of transferring a defined benefit scheme is much more more prescriptive and requires independent reports, is more costly, and professional indemnity insurers don't cover for that risk. So most independent financial practices will only accept a defined benefit transfer if the client does so on an insistent client basis. Yeah. So we are finding that the UK pensions industry is making it difficult for Brits moving abroad to get their transfers across. Yeah,
no, absolutely. It's more difficult, and it wouldn't surprise me if they squeeze that even more. So I think the takeaway from that is, if it's something that you've been considering before or something that you may be interested in, it's probably something that you should look at sooner rather than later. Absolutely. Because it may remain open, but it wouldn't surprise us if that door closes a little bit more. So we talk about the UK pension transfers and how that can be a useful transfer for an individual. So when we talk about the UK pensions, we are talking about your UK SIP, potentially a defined benefit pension, although that has to go through a more arduous process these days, but it's still potential. But you can move if you are a tax resident in Spain, you've moved here, you're enjoying your life here, you can move your pension to a QOPS, which is a qualifying recognized overseas pension scheme. Now, generally, the best place for this to be held is in Malta. Malta has a double taxation agreement with Spain, and there's no withholding tax, so it's a very suitable place to hold the pension. Now, there's a few reasons why you might want to consider this. Now, the first one is your lifetime allowance. So in the UK, we have a lifetime allowance limit of, well, it's 1,073,100. I think we're missing the 100 on there. And what that means is at some point in your lifetime, your pensions will have what they call a benefit crystallization event. When that happens, it tests the amount of your pensions against a lifetime allowance. And if you are over the lifetime allowance, then you will pay a penalty for that 25% or 55% if you want to access that money as a lump sum. Now, the beauty of a transfer to a QOP, so if somebody is approaching this limit or already above it, once you transfer your pension assets to a QOP, the benefit crystallization event happens when the transfer takes place. So your pension can continue to grow after that, and there's no additional benefit crystallization test, no more assessment, and therefore it can grow beyond that tax.
So a transfer from a UK pension to a QOP is considered a benefit crystallization event?
Correct, yeah.
And just to clarify the point you've made very clear, if you're very close to the lifetime allowance limit, but it's below that, it might be the opportune time to transfer those UK pension benefits across, because you haven't reached the threshold,
yeah,
which means that there is no liability to tax at 25%, assuming it's income that you're going to do.
exactly,
right?
yeah.
So you do it just before, and there's no liability whatsoever.
Yeah.
If for whatever reason, and let's give an example, that those accrued UK pension benefits are 1.2 million.
Yes.
Then when you crystallize those, and the act of transferring is a crystallization event.
Correct, yeah.
When you transfer those 1.2, the excess between 1.2 million and 1,073,000, which is roughly what, 127,000,
yeah,
would be subject to tax at 25%.
Correct.
But I think the point you are making is, even if you pay that small liability to transfer the whole amount,
yeah,
from that point on, ad infinitum, if it continues growing to 2-3 million, there's no further liability to the lifetime allowance charge, since you are outside the scope of the UK pension legislation. Yeah,
exactly. You will have to have the benefit crystallization event at some point. So have it earlier. The earlier the better. And using your example, it's 1.2. If your pension just grows up to 1.3, not much growth,
yeah,
in a small period of time, instantly you've saved yourself 25% on that extra growth. So it's
almost 75,000.
Yeah, exactly. Yeah, yeah. So that is one good reason for someone near that limit. But even if that's not the case, there are other reasons why you may want to do it. So an income from a QOP can benefit from a much reduced rate of taxation. Now, this is a little bit complicated and probably something we need to look at on an individual basis. But it is possible to withdraw your income using a fixed amount per year, using what they call a temporary annuity, not an annuity that we know in the UK. This is a different way of doing so. And you fix this over a long period of time. And because of the way that is set up, the authorities in Spain only view part of that pension income to be taxable. Now that depends on your age and how long the annuity is fixed for. But in reality, what that can do is reduce your tax rate that you pay on your pension income to single figures. Now, there are caveats involved in that. It depends how your pension was funded originally. If you've transferred to a QOPS from a defined benefit that's just purely being funded by your employer, it's not going to work. That's an employer-funded scheme.
In theory, it shouldn't work.
Correct.
Because the Spanish legislation is very clear on that.
Yeah.
As you rightly say, if it's employee-sponsored, no, you're not. You can't claim for. You can't structure your pension income as an annuity.
Yeah.
However, if you build up that pension from your after-tax earnings, then in theory you should be able to do so. No?
Yeah, and if it can be from your contribution, so it becomes a little bit grey, because it's not unusual now for people to have pensions from various sources. Maybe you've consolidated pensions into one part, and we have to ask ourselves, how far will the Spanish tax authorities look into that, and it's very difficult for them to see where the original capital was derived from. So it needs to be looked at on an individual basis, but it's still an option there. The door is still open, and something that can really reduce the tax rate you pay on your pension income. And then the final point with the, well, actually there were 2 points. I'll add an extra one, but the final point we have on there is if UK pension legislation says if an individual dies after age 75, there will be a tax liability on your beneficiaries. They will pay income tax at their marginal rates on the pension. If you die age 75 or older with a QOPS, then you can pass that pension on to your surviving spouse with no tax liability. They can continue to take the payments at the same rate of tax.
Because in the UK, it's not that you haven't got a liability, it's a deferral mechanism.
Yes.
Would that be fair to say?
Yeah, it's a bit of an odd one because the pension is outside of your estate for inheritance tax because pensions don't count, but they catch you a second way. They catch you, and if you're, the difference is the age of the deceased. If it's 75 or over, they will catch you that separate way. Whereas a QOPS, there's ways around that, so it's possible to do that. The final benefit is we know legislation is changing all the time, and there will be taxation changes. We know that. We know what's happening with economies, and we've seen kind of recent budgets with the UK, and they will need to increase taxation somehow. We've seen in the past the lifetime allowance being reduced. I think at some point it was 2.1 million, was it?
It was 2.1, it came down to 1.6, and then gradually, and now it's actually frozen.
Yeah.
Till the budget of April 2026.
Yeah.
So it's been coming down over time.
Exactly. So moving your pension out of the UK does protect yourself from those changes in legislation that may happen further down the line as well. And then we go back in time a little bit to Paul spoke earlier about inheritance tax, and the chances are that you will be UK domiciled, and therefore you're still exposed to UK inheritance tax, which a lot of people don't understand. People think I've moved out, Spain, the UK is behind me, I don't need to worry about that. That's not the case. Now, a very smart solution to that is something called a QNUPS, a qualifying non-UK pension scheme. The structure of it is similar to a QOPS. The main difference is that it's funded by a lump sum investment. It's a pension scheme, so there's no capital gains during the growth of the pension like a QOPS. We talk about the reduced rate of taxation you can pay on a QOPS. A QOPS can be a little bit grey depending on the funding. A QNUP says no doubt you funded it by a lump sum, therefore you can pay a much reduced rate of taxation on those income payments. But a key consideration is that you invest a sum of money into a QNUP and it's immediately outside of your estate for UK IHT. It's a pension scheme. We said a couple of minutes ago, pensions in the UK are outside of your UK IHT. The only caveat on that is it has to be set up as a genuine retirement vehicle, a genuine pension.
Well, even if you return back to the UK.
That's a good point.
That's one. And secondly, that unlike a UK pension where the beneficiaries are still liable to tax when they actually withdraw the funds, so it's a tax deferral. With a QNUPS, there's no such liability.
Same,
they can get a whole lot and that's it.
Exactly, same as a QOPS, doesn't matter what kind of age pass away. So it has to be a genuine pension, and what we mean by that is it's going to be in line with your wealth, age, future income requirements. To give an example, if we've got an individual, they've got net assets of 2 million, they're now age 75, they're concerned about their UK IHT, they come to us and say, great, that QNUP sounds wonderful. I'm going to stick 1.52 million in that. Jobs are good on. That won't work because that's a clear IHT fudge. So the key with the QNUPs is plan early. The earlier you plan, the more you will be able to contribute to it, and the more it's a genuine retirement vehicle. And the beauty is you can invest this sum of money into the QNUPs, and then you can set up income, which is funding your lifestyle in Spain. But it's key to do it early as possible. the older we get, that door closes and closes, and it has to be a genuine pension. So we move on to the next category, which is capital gains tax. So we have capital gains tax in Spain, just like many countries. The rates vary. It works on a bit of a tiered rate. So it starts at 19% all the way up to 26%, depending on the amount of the gain in that year. The first tier, 19%, is for gains up to 6,000 euros. Then it moves up to 21%, 23%, and then finally up to 26% in the end. So capital gains is there, and a possible tax. So someone with investments, they may have been used to UK products, investment bonds, or an ISA. They're no longer suitable for those not living in the UK. So we do have an alternative, which is the Spanish compliant investment bond. So if you've got a sum of money to invest, this can be an alternative to a QNOPS. Sometimes a QNOPS is more suitable, sometimes a Spanish compliant bond. You could use a combination of the two. Again, it's down to your individual circumstances. We're not here to say this is the product for everyone. That's not how we operate. We want to speak to you on a one-to-one basis and identify what's the best for your situation. But in brief, the Spanish compliant investment bond, there's no immediate capital gains. It's a tax wrapper, a life insurance contract around a portfolio of assets, and the taxation only takes place when you make a withdrawal or surrender the policy. And the beauty of that from an admin point of view is the bond providers actually pay the tax directly to Hacienda for you. So you make a withdrawal, you receive the net process, and they sort that out for you. With a Spanish compliant bond, it can be set up in joint names, so there's no succession tax on first death if you are in a region where there is succession tax. And if your ultimate beneficiary is in the UK or well, not in Spain, then there will be no succession tax then. So we've got a kind of quick example there of how a Spanish compliant bond works. So you invest a sum of money, it grows over time, and then you wish to take a withdrawal. In this example, the investments are 100,000 euros. It's grown to 150. You want to surrender 15,000 pounds. Maybe you've got a big holiday planned, you're buying a car, whatever you want to do with that money. So the bond calculates what is return of capital, which isn't taxed, and what is the gain, which is taxed, depending on the size of the gain. In this example, it's 5,000, so it's 19%. And then the client receives the proceeds after the tax is taken. This example, there's 950 euros tax that's paid direct to Hacienda. So the effective tax rate calculates at 6.3%. So there are ways to mitigate against capital gains tax, and this is one example where you can do that. So I'll just go back a couple of slides, Paul, and if you can help me with wealth tax in Spain. We're not used to wealth tax in the UK. It's reasonably unique to Spain and a couple of other countries. We're talking about taxation in Andalusia here, and there's been a change to, well, there's been two changes to wealth tax in the last couple of weeks, which really shows Spain not at its best planning. If you could tell us a bit about that.
Absolutely. I mean, you're quite right. The autonomous regions in Spain have full discretion to apply Spanish wealth tax as they please. And we have just seen quite recently, in fact, 2 weeks ago, there was a right-wing regional government in Andalusia scrapping Spanish wealth tax to attract high net worth individuals, because Portugal is becoming the country of choice for expatriates looking to migrate to the Iberian Peninsula because of the non-habitual residency regime. So that's one of the reasons why they scrapped Spanish wealth tax. The other one being that I think in terms of the overall tax receipts, Spanish wealth tax only accounted for 0.6% of total tax revenue. So thinking about it logically, the actual cost of collection exceeded the actual benefit of the tax itself. So they quite wisely scrapped it. That must have been 20th of September. only for a left-wing national government to announce last week that they were reintroducing Spanish wealth tax, but this time at national level. They call it a solidarity tax because of, high energy prices and, the issues that we're facing with high inflation, post-pandemic and so on. But from what I hear, it's apparently been driven by a junior partners in the coalition government of the Socialist Party, Podemos, which is effectively a communist party, and they have been pushing for a reintroduction of Spanish wealth tax. It's only in draft law form. It needs to be approved by the Congress, potentially either later this year, but most likely the beginning of next year, and it will be introduced in 2023 and 2024, provided there's no election and a right-wing government is elected, in which case it probably be scrapped again. But the way it works, it's aimed at high net worth individuals with wealth in excess of 3 million. So if your net wealth is between 3 and 5 million, you pay an annual punitive tax of 1.7%. If your wealth is greater than 5 but less than 10, then you pay an annual tax of 2.1% on your wealth. And then finally, for individuals whose wealth exceeds 10 million euros, you pay an annual tax of 3.5%. So they're quite steep taxes for, considering that on the one hand, you've got right-wing regional governments looking to attract inward investment, only for a left-wing central government to be thinking about the short-term tax raising measures, but not looking at the bigger picture.
Yeah, no, I mean, to take the kind of political side out of the way, I think the decision to scrap the wealth tax, just on a purely financial point of view, made sense. They've done the calculations. What wealth tax brings in doesn't compensate for pushing wealthy people out of the country or not even letting them in, but they've ignored that, and they're trying to introduce this new solidarity tax, and I think it's watch this space to see what happens with that.
It's drafting, so there's no guarantee that it will pass through Congress, but since the left-wing government has a majority, there's a strong possibility that they might just do that. But it seems to me very short-sighted in the sense that they are competing with Portugal to attract high net worth individuals. Portugal is proving to be a magnet for expatriates across the globe because of a fantastic 10-year tax regime. Spain realizes, or at least some regional governments realize, that they are on a hiding to nothing because they haven't got any tax incentives. So they tinker on the edges quite rightly, only for the national government to overturn it, 10 days later. And the strange thing is that regional Spanish wealth tax has always been has been introduced at a regional level. And having been scrapped at regional level, why would they then come a week later and introduce it at national level when they've never done it before? But hey, Spain is an amazing country, but when it comes to taxation and certainty and stability, I don't think that's their forte. No,
I think that's an interesting takeaway from this in the sense that in the UK, everything's black and white with taxation. We know where we stand, we follow this, whereas Spain doesn't have the same luxury. There is a grayness to it. There are these changes, and that's where you need to be very careful and understand the process and work with people that can help you kind of guide through the minefield, really.
Yeah.
Wonderful. So we covered that. So great. We're almost towards the end there. Paul, I think you have a couple of questions for me. So we've got some quite simple, frequently asked questions that we face more often than maybe we should, but fire away, Paul.
Yeah, 3 questions for you, Matt. Can someone relocate to Spain but remain UK tax resident?
Very simple. If you become a Spanish tax resident, which in very simple terms, you spend more than 183 days here, no. You become a Spanish tax resident and you have to pay your taxes here. Now, there are some caveats where you have to continue paying the tax in the UK. If you have UK rental property, you will pay the tax there, but you still need to declare that amount on your Spanish taxation, your annual taxation. You will, there's a double taxation agreement, so you will get credit for that tax pay, but yes, you live in Spain, you need to pay taxes here, which is surprisingly how few people realize that.
I have another question. What happens with someone's UK state pension when they move to Spain?
Okay, great. You continue to receive it. You can opt for it to be paid into a Spanish bank account if you want, and as long as you exit the UK properly, which we talk about in a different webinar, it's possible to receive that gross. And because of the way the double taxation agreement works, it is still index linked. So it's still the triple lock. When the government apply it, the triple lock still works if you're in receipt of a UK state pension, but you're not living in the UK. There are some countries where that doesn't work and it's not index linked, so you've got a flat, but in Spain it will continue to increase.
And my last question is, can you keep UK ISAs when you move to Spain, and do they continue to be tax efficient? Okay,
good. So I think I covered that briefly earlier, but yes, your ISAs, as soon as you relocate out to the UK, to Spain or other countries, actually, the tax benefits an ISA are lost immediately. So the ISA is not there, so you will have to pay capital gains tax, or maybe even income or dividend tax if you're receiving from that. Generally, the ISA providers, once they realize you're not in the UK as well, they don't want to continue servicing you. And in reality, it's not the right products. It's a product for UK tax residents. If you're now living in Spain, then you need to assess your options and look what's available for you. So Paul, a bit of revenge. I'll ask you one question in response, but a very important question. Here at Fiduciary Wealth, we talk to a lot of people who are either thinking of relocating or maybe already here, but what's one key bit of advice you would give to everyone when they're considering their finances in Spain?
Well, firstly, you have to have a plan and a timeline. You need to have an advisor by your side that can guide you through the process, and then you have to stick to the plan and execute it correctly. And you know, you can be penny wise but pound foolish, trying to think that you know all the steps in the process, and that can prove to be very painful and costly. So it's worth having an advisor that can hold your hand through the process to ensure a smooth and seamless transition to your new country of residence. This is not a race. You don't have to be the head, you can be the tortoise. You know, it's not about speed. It's about making sure that you take all the appropriate steps in the right order, and that when you land in Spain, you can not think about finances again, because everything is taken care of, and you've got a credible, respectable partner by your side that can take care of everything. So acting as a single point of contact. And then the other thing which I have to mention yet again is UK inheritance tax. You know, the last thing we want is a negative posthumous decision by HMRC to deprive your heirs, your children, from their inheritance. So, you know, the concept of UK domicile always hangs over your head like the sort of
Damocles, is it? Damocles, yeah.
You always have to be aware that it's just there, it's an issue.
Yeah.
More than Spanish inheritance tax, succession tax. So you need to restructure those assets so they are bulletproof from UK IHT, which we can do. But like everything, planning has to start now. You can't leave it when you're on your deathbed.
Yeah.
Or when you reach a certain age when those tax planning opportunities are no longer available.
Okay, so plan properly. The earlier you start, the better.
Yeah.
And Google and Facebook groups are really useful, but you're talking about your finances. if you follow some of, I mean, we've seen some rubbish online before that of course has some good stuff, but how do you know what's the good stuff? You talk to somebody who knows what they're talking about, who can guide you through the process and give you that peace of mind.
Absolutely.
Wonderful. So we've reached the end of the webinar. We open up to your questions there. And well, we've got a couple of questions from an anonymous attendee, which makes me wonder why they want to hide their...
Well, we are quite happy, Matt, to answer any questions from attendees if they disclose who they are.
Yeah.
You know, we're very open and honest in our dealings with third parties, one of our core values, and if we invite them to the webinar, we expect them to be just as open as we are and to disclose their name. They're not paying to participate in the webinar. I don't see why they should do so under anonymity. Yeah, absolutely. Anonymous attendee, I don't know how it works. Maybe you've accidentally hidden your name there for whatever reason, but if you want to reach out directly, introduce yourself, we'll be more than happy to answer both your questions there. But yes, we want to know who we're talking to. So I don't think there's any more questions on there. So we thank you all for your attendance. We hope that it's been of value for you, and our contact details are there should you wish to speak to us. Like we say, it's important to do these things properly. Make sure you're talking to someone who knows what they're doing, which is us. So thank you for attending. Please go to our YouTube site and have a look at our other videos, share, subscribe to those, and hopefully we'll speak to you soon. Thank you. Thank you. Bye-bye.